USDA forecasts record production, but prices rally anyway. Harvest delays, acreage questions, South American weather, and the Wall Street meltdown are all in play for turbulent October markets. Senior editor Bob Bergdorfer joins me to discuss what's happening and why, and what you should be doing about it. As I pointed out in my weekly reviews on farmfutures.com, it's not unusual for corn, soybeans, and wheat to rally in October, even during years of good production. But with USDA forecasting record crops, this year's October surprise was a shock. Markets never trade in one direction forever. This year, harvest delays eased hedge pressure, which fueled short covering by speculators, and that buying began to feed off itself when tripwires on price charts were triggered for technical traders. The result was a good selling opportunity for farmers needing to make sales. Unless you can find an end user who needs delivery right away, weak basis means those sales must be made with futures or hedge-to-arrive contracts on inventory that will be stored. How fast basis improves depends in part on transportation costs. Rail and freight costs eased a little from record levels a few weeks ago, but the expense of moving grain remains historically high. Bob, is the rail situation getting any better? And how long will it take for costs to come down?
Rail car rates have come down in recent weeks in the secondary market, indicating a little better availability, but rates still remain quite high. The latest rates I saw were over $2,000 above tariff for non-shuttle cars and about $4,000 for shuttles. Still very expensive. I think the severity of this winter will determine if and when the rates come down. The other market to watch are barges. Rates for grain barges are extremely high, up more than 50% from the 3-year average. Part of that is obviously as the demand to ship crops to the Gulf has increased. Last week we saw barge movements up 38% from a year ago. The harvest delays that you mentioned have created some weakness in the latest week on the barges, but beyond that, the rates are still very high.
Besides transportation, the other factors driving basis are supply and demand. For corn, USDA's October 10th report increased production by 80 million bushels, less than expected, but the crop is still huge at 14.475 billion bushels. The agency increased its yields even more by 2.5 bushels per acre to 174.2, in part because it reduced harvested acres by 742,000. That shift was presumably affected by Farm Service Agency data out this morning, which continues to show fewer acres than projected. If FSA offices are up to date with their record keeping, and that's a big if, my forecast shows harvested acres could be down another 1.4 million. That would reduce the higher carryout reported by USDA October 10th, but make no mistake, ending stocks would still be big, around 1.8 billion bushels or more. And there's a chance the crop could still be as big as USDA reported, which would bump up yields to 177 bushels per acre or better. The problem is not only with supply, but demand as well. The U.S. faces stiff export competition. Ethanol margins are pummeled by the collapse in energy prices, and livestock feeding isn't expanding fast enough to eat into supplies. The soybean situation is much the same. USDA raised its forecast production October 10th by just 14 million bushels to 3.942 billion, raising yields a half a bushel per acre to 47.1, as harvested acres fell by 650,000. The FSA data suggests acreage could be down another 800,000, but supplies still look large. USDA cut carryout to 450 million bushels, but that's still a burdensome level. Demand remains strong for soybeans. Exports are running at record levels, and crush margins are attractive. What about those crush numbers out Wednesday, Bob?
Soybean crush for September was under 100 million bushels for the first time in years. That is largely due to the tight stocks and the late harvest. I would think that once harvest gains traction, we should see some improvement in that. The positive news is the report showed exports of quite a bit above August and more than a year ago. And that, of course, coincides with USDA's weekly export numbers, which show above year-ago sales on soy meal.
The other factor helping support soybeans this week came from South America. Planting is off to a slow start in Brazil, where there's been too much rain in the south and not enough in the key center west. Forecasts are looking wetter for Mato Grosso, however, and farmers there have forward priced less of their crop than normal, which could eventually increase selling pressure on May and July futures. Here in the U.S., the eastern Midwest is soggy, seeing plenty of harvest delays. Farmers making better progress in the west, but they're still behind average. Bob, what's the outlook for the rest of harvest, and what does it mean for winter wheat seeding and establishment?
It seems that rain is falling somewhere in the Midwest every day. Yes, harvest has been delayed on the corn and the soybeans, but longer-term forecasts show drier pattern for the Midwest beginning next week and lasting through the end of the month, and that should allow farmers back in the fields for at least 2 weeks as far as the forecast suggests. Winter wheat seeding is going well. There have been some rain delays there too in the Central Plains. However, farmers there are just glad for the moisture, which is, as you know, was in short supply last year. As of Sunday, 68% of the wheat crop was planted against the 67 average, and in Kansas it was about the same and a little bit behind the average. Soil moisture levels in Kansas are much better than last year, and crop emergence is ahead of the 5-year average. Planting of soft red winter wheat in the Midwest is behind because of the rain as well. In the Southern Plains and in the Pacific Northwest, wheat planting is running a little bit ahead of averages.
Big swings in crop prices aren't unusual, but volatility in other markets hung over Chicago this week, something farmers ignore at their peril. The Dow turned negative for the year, dropping below its key 200-day moving average, and the VIX Fear Index moved to its highest level in almost 3 years. Fears from Ebola to weak global growth fueled the sell-off, which sent crude oil and diesel to 4-year lows. That provided a good buying opportunity to start locking in 2015 fuel needs, and there was even talk that money was moving out of stocks and crude oil into the grain market, something we haven't seen in quite a while. But weaker global growth could also hurt demand for grains and oilseeds. That's a reminder not to get too carried away by the October rally. Lower prices are still more likely than not. Well, that's all for this week. We'll be back soon with another edition of The Buzz.
We'll have to have more margin now, there isn't any doubt. So you better dash with the load